Welcome to Second Take, the show that focuses on the issues behind the news. Gold producer Goldfields says that forced government stoppages at mines when incidents occur have weighed on the free cash generation in South Africa. Mining Weekly editor Martin Creamer is with me in the studio to unpack the issue. Welcome to Second Take, Martin.
Thanks, Shannon.
Goldfields is speaking to government about a new stoppage protocol. What has led to this negotiation?
Well, the background to this is safety. So the government decided that if there were incidents of injury or death, they would issue a notice and they would close the mine until safety was restored. Now, what Goldfields is saying is that they agree fully, with the safety issue, but that the way this is served is punitive, and it lacks proportionality, because what happens is, there's an incident at a shaft, and that shaft is closed, but also all the other shafts are closed in the vicinity that have no relation to the incident. So they want to sit down with the government at a workshop this month and actually try and thrash out a new a protocol, a government's mine stoppage protocol. And they think they've got a lot of common ground on this, because not only have they suffered from mine stoppage, but these mines don't lend themselves to stopping and starting. They need to be continuously operated. So to get them back up to speed takes a long time. And as a result, some of the big mines in the group, like Driefontein and Kloof, failed to meet their call, whereas they would have produced those tonnage targets had they not had these stoppages and had that long ramp-up time to start again not being the case. They would have actually had a free cash flow. But what caught the ears of many at the presentation of Goldfields was that the South African operations did not generate a free cash flow in the quarter to December.
Now, another hot topic is the electricity costs. What is Goldfields' take on this?
Now, Goldfields' take is a little bit different to that of the Chamber of Mines, and the CEO, Nick Holland, has actually presented to NERSA separately on what he believes should be done. He sees that the error created with the electricity situation, keeping the prices artificially low, has been a long-term issue. So people have, for over a long period of time, not lifted the electricity tariff to the level that was sustainable, and now we're in trouble. So he feels that there should be a longer-term solution, and that this should be solved rather through the introduction of a broader-based tax, so that it's not punitive for the particular users of electricity in the short term. And also that there should be some sort of longer-term tariff path to create certainty for mines. And I think those are two important issues that he's introduced into the debate on this very high electricity tariff of currently 35% every year for 3 years, which a lot of people are kicking against. And it was 45%, but they're not saying, well done for bringing it down. They want it brought down to much lower levels and dealt with differently.
Now, why is Goldfields introducing a new 6-day continuous mining calendar?
You see, we've got this situation that South African gold stocks are being discounted in world markets, because you will have a very big company like Goldfields with massive assets and producing 3.6 million ounces of gold being valued the same as some much smaller foreign company with less reserves and probably producing a fraction of gold when you compare it to Goldfields, but being valued the same. And this is very confusing, because what is happening is that the market is seeing a situation in South Africa of rising costs, continually rising costs. And as a result of that, they're downgrading the value of the shares of these companies, which has a big impact for them. So what Goldfields is trying to do is overcome this issue of cost rises by actually being more productive. So what they want to introduce is what is called FULCO, which is full calendar operations. But it's a FULCO hybrid. Instead of going for the full 7 days continuous mining, they're going for 6 days of continuous mining. And they feel that would just give that extra productivity to discount the cost issues and also to sweat the assets, which they would like to do.
And then finally, the South African operations normally save the day for Goldfields' foreign operations, but not this time around.
No,
Why?
Not this time around. We've seen that the South African operations in the December quarter failed to generate a free cash flow. But fortunately, ramping up elsewhere was Cerro Corona in Peru, which turned out to be an absolute star. And also, the operations in West Africa came to the party. So we had a situation where the diversity, the geographical diversity, paid off for Goldfields in the December quarter. And whereas normally it's the South African operations, the big Driefontein and Kloof and even Beatrix now coming to the party that made the big contributions to cash, it was actually those outside the country that did well for Goldfields, which didn't have a bad quarter. It had a very solid quarter. It was, I think its profits were 1.4 billion rand, so that's nothing to sneeze at. But they're looking now to actually making sure that those South African operations are dealt with in a way that they generate the cash flow that they can. And that those stoppages that were introduced as an administrative stoppage brought about by the government, that they go away and that they actually then introduce a 6-day week to get themselves ahead of the game.
Thank you so much for your time, Martin.
It's a great pleasure, Shannon.
That's the show for today. Join us again next time for more news and insights into what's happening in the mining world.